I'm seeing more and more cracks widening in the stock market, and it's making me more and more concerned. I'm trying to stay bullish because this is the seasonally strong period for the stock market. But after having such a strong August, strong September, strong October, each of those months are the most dangerous months of the year for the S&P 500, where we typically will see some sort of big drawdown in one of those months, if not more of them. We just never got it. In fact, buyers stepped in so quickly that there was barely any pullback. And now we are probably paying the price. I find it very telling that the market rallied to an all-time high at the beginning of the government shutdown. And now the government shutdown finally ends. What does the market do? It deepens the sell-off. Now we're at the point where the major indices are struggling to hold on to critical support. I have charts to show that to you. And unfortunately, the small caps are now officially bearish. Very disappointing for me. I'll show the charts for that. And then after I show the makeup of the stock market with the major indices, I'll go into the individual stocks. Going to have to start with Oracle. I have a bunch of tech stocks to get through. The AI story is very slowly, but maybe surely unraveling a bit. I have software stocks to show. Unfortunately, I have a lot of bad news, and I've tried to insert some good news along the way. But overall, fortunately, this is just the most bearish video I've put out in quite some time. So just want to give that caution to you, or that heads up. If you don't want to hear anything bearish or bad about the stock market or about the financial markets, you're free to go right now. But this is just what it is. These are the charts as they are. So after I go through some big cap tech and some software stocks, a lot of breakdowns happening. I have to talk about some EVs like Tesla, Lucid, and then I'm going to end off with crypto and the companies that are trying to make money off of treasury operations. It's not looking good there either. I'm trying to hang on one of those plays. Let's take a look at these stocks as cracks continue to widen in the stock market. Chart shows the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. The big feature you should notice is that market breadth has been in decline for months. I've been pointing this out over and over again. The underlying health of the market continues to deteriorate, and this is what has me worried no matter what kind of melt up the stock market it is in. Last week, market breadth hit a new level, a level that it hadn't seen since late April. There was a rebound to start the week, and it totally fizzled out the last 2 days of this week, which is today is November 14th, 2025. And on top of that, market breadth is pretty much flat on the week. So let me just zoom in here so you can see this is the overall downtrend, and you can see market breadth is just bouncing in a range, but a range that is biased downwards. We see not quite the similar thing with the percentage of stocks trading above their 200-day moving averages, which is what, of course, I like to call AT200. It is also bouncing around, but the downtrend is much more shallow. So the longer-term health of market breadth is looking better, but still short-term, I just get more and more worried the longer this goes on. One of the main reasons why I'm hanging in there is because we are in the seasonally strong period of the year. So I don't want to get overly bearish when the overall bias in the market over the next coming months will be to buy, and buy. Okay, let's dive into the major indices, S&P 500. You could see the overall view if you want to pause and take a look at all of these wonderful tabs and tags that point out some key milestones. The main key milestone recently are these. Fed rate cut was marked the top of the S&P 500. There is a 500-day moving average support. The 500-day moving average support was tested last week, retested on Thursday. That was yesterday. And today, the market gapped down below. That was very bearish, but buyers, imagine that, stepped into the breach and pulled the S&P 500 above the 50-day moving average. And why is this so important? This is so important because the S&P 500 has not closed below its 50-day moving average since April. That is how strong this market rally has been since the drama trauma and noise of the tariffs earlier this year. Just a constant, near constant buying mood in the market. So these breaches of the 50-day moving average and recoveries are very significant. They show that buyers are trying to defend this uptrend. But as I showed, since market breadth is actually biased downwards, at some point, something has to give. And unfortunately, right now, it looks like market breadth is winning. And because as you'll see, let's see, the NASDAQ looks like the S&P 500. I don't need to go over this whole string, just to note that the NASDAQ just barely closed above the 50-day moving average. So this is of increasing concern for tech stocks, as I wrote about and talked about last week. One of the major problems for tech is that there's a growing fear of an AI bubble, and that is starting to cascade through the sector as people sell and take profits after a great year of gains. Now, even more concerning is IWM, iShares Russell 2000 ETF, because it has already confirmed a breakdown below its 50-day moving average. Not only that, it's below its previous all-time high. And you see this dashed line here? That's the 20-day moving average, and that's starting to point downwards. So almost everywhere I look, IWM is indeed bearish. I'm not shorting, of course, because I have shares and I'm holding this for the long term. But just because I'm bullish on small caps over the long term doesn't mean that it can't get bearish in the short term. That's where IWM is now. I'm very disappointed, of course, but it is what it is. I went ahead because I saw this action all over the place in the market, which is gap down and then buyers rushing in into the breach and taking things higher. I went ahead and did one more short-term play with IWM calls. Actually, I did a calendar call spread, as I often do, because I don't want to pay the high premiums for implied volatility. And what you can see here is that IWM managed to close a little bit higher than flat, 0.3% up for the day. But again, it is bearish, so I'm only playing for like a rebound back to what's now going to be resistance from either the previous all-time high or the 50-day moving average or the downtrending 20-day moving average. Poor IWM is in trouble and back to underperforming. Let me go ahead and switch this over to logarithmic before we look at the individual stocks. Now, I'm going to go into some individual stocks. Of course, there's a lot more to tell in the stock market. I can only cover so much, but these are the key stocks, not key stocks. These are some stocks that really caught my interest. Each one has a story that I want to tell. Let's start off with Oracle. I mean, Oracle has to be top of the list in terms of the AI fears that are unfolding. Oracle's at the top. And you could see that when Oracle announced this huge $350 billion deal, revenue deal, back in September that sent the stock up 36%, buyers could not get any more momentum after that. And that was a tell. And Oracle has since drifted down first for about a little over a month and then straight down ever since. And now it has breached all these supports, has reversed all of those 36% gains, 36% post-earnings gains, all the way to this picture-perfect test of 200-day moving average support. Now, normally, I would be rushing in to buy some Oracle and celebrate picking a bottom. I think Oracle could bounce. Maybe it'll get back to the low of the post-earnings gap up. That would be a natural place to jump up to, particularly with the 20-day moving average converging on top of that line. But I don't want to play that game for Oracle. I'm really worried that this is the first signal of many to come that buyers are now finally exhausted trying to play the AI trade. Now, overall, again, I'm bullish on the AI trade, but I'm getting a little bit more wary. I'm already bearish on Oracle because of its breach of its 50-day moving average, which again is this red line. So I'm wary, but overall I'm bullish, but I'm getting less and less so with time. And at some point, if I see more and more breaches, I'm just going to have to take profits in some of my key names. Anyway, so Oracle's the lead story. Of course, then if Oracle's the lead story, Nvidia has to be the second lead story because it's going to report earnings next week. It is more bullish because it is holding on to 50-day moving average support. It's sloppy, but still 50-day moving average support is holding as general support. You can see the uptrend is flattened out on Nvidia, so that's not so great. And it's trading once again under its previous all-time high. It made this double top move, and I forgot to label it because these were all-time highs, but buyers faded or sellers faded the stock off of intraday highs. So this is another bearish topping pattern. Now, granted, Nvidia has printed so many bearish topping patterns. I mean, here's another one back here, right before DeepSeek. And Nvidia has been a champ, conquering all. So eventually, I suspect it'll conquer this latest topping pattern. But for now, things are a little dicey. Let's see what happens in earnings in this coming week. And of course, I labeled here, Michael Burry picked a very opportune time to announce that he's bearish on the AI trade, and he put his money, unlike a lot of the people who are complaining about a bubble, he put his money where his mouth is. And so far, so good for him, and not for the rest of us who are in various AI trades. Okay, from here, let's just take a look at the semiconductor index, the VanEck Semiconductor ETF, because this will just tell you the general health of semiconductor stocks. And you can see overall short term October, from late October to now, it's been a downtrend. And importantly, it had also a picture perfect test of 50-day moving average support. That means that the technicals are working both on the individual stock level and on the ETF level. I love that because there's perfect poetry and synchronicity across the stock market. So I am now watching this very closely, because a breakdown from here for the ETF, a confirmed breakdown, which means two closes below the 50-day moving average, will be bearish for semiconductors in general. That would be yet one more bad sign for the AI trade in particular, since it's been the AI trade powering a lot of the semiconductor stories. Let's go over to software. Once again, picture perfect test. This was not of the 50-day moving average, it's of the 200-day moving average, which is the blue line. So given the confirmed 50-day moving average breakdown, I already think of IGV as bearish, but this defense of 200-day moving average of the 200-day moving average is encouraging. And if it closes higher, one more level higher, it would signal to me that the bearish phase is already ending. And I might even buy IGV on that case. But however, of course, if it breaks down below the 200-day moving average, that will further reinforce the bearish topping for IGV, which is the iShares Expanded Tech-Software sector ETF. And there's a lot of big cap tech software companies in here. Some are AI trade related and some aren't. Now, okay, enough dire news. Let's look at some of the positives, a few positives for today. Datadog, one of the few stocks that after being included in the S&P 500 actually is much higher ever since. It benefited from a 23.1% post-earnings gain. I'm sorry, Datadog, if I remember correctly, it does a lot of monitoring of data ecosystems and servers and networks and all that kind of good stuff. So I love this move. It's very bullish. This pullback is a natural pullback, cooling price action off. So I actually have Datadog on my buy list. I will buy, let's see, let me zoom in here for you. I would buy as soon as the stock crosses above the intraday high from today, which is about let's just call it 188. Okay, so that's actually a bullish point. Now let's get back to the bad news. I had to just take a break. ARK Innovation ETF, ticker symbol ARKK, is in bearish territory. I am long. I sold some call options against the position. Of course, those call options now have expired. Worthless. I just had this ongoing strategy ever since ARK first finally broke out above its pre-pandemic high. I just turned bullish. Now, that bullishness helped me when I was buying ARK down here, despite the bearishness of these breakdowns, and I benefited. I can't remember where I took profits. I took profits somewhere around here. And then when ARK continued, when it broke out, when it had this fresh breakout here, I decided to start trading it again. I can't remember what cycle I'm on now. I'm not trying to buy ARK for the long term necessarily, but my latest trade right now is in the red. Not as bad since I did sell call options against it. I think ARK is bearish. This is another bad sign for just tech in general and speculation in general. I suspect ARK is going to test its 200-day moving average in due time. That's just that's a reflection of the bearishness I see here. Now, part of ARK, as we all know. Tesla plays a big role. And this is one of the reasons why I think ARK will eventually test its 200-day moving average is because Tesla broke down this week. This was yesterday, 50-day moving average plunge breakdown on news of a plunge in China sales. That was a 6.6% loss. That's pretty serious. You can see down here, big spike in volume. This pop off of the lows. Now, first of all, this big gap down at the open was huge. This is just further confirming how much selling pressure Tesla is under right now. It is impressive that buyers took the stock all the way back up to a 0.6% gain on the day. However, notice that it faded off the intraday high. Sorry, let me zoom in here so you can see that it faded off the intraday high. So, and took it off of the lower Bollinger Band, which is an extreme point of price volatility or price range. So anyway, all that to say is that this is somewhat encouraging for Tesla's stock, but overall it is bearish. I think over time, unless there's a positive catalyst that shows up, Tesla could drift its way back to a 200-day moving average test, which would help bring ARK down to such a 200-day moving average test. So just to review, Tesla's in bearish territory now, even though it usually I call a confirmation on a second consecutive close or a second close below that support line. I think I'm just going to call it bearish, and it won't be bullish again until it pops up above its 50-day moving average, or it gives a picture perfect test of the 200-day moving average. All right, more bad news. Disney confirmed 200-day moving average breakdown on a 7.8% post-earnings loss. I think overall people are just disappointed. The expectations seem to be too high for Disney. Let's just roll back. This looks serious, but when I roll back, I don't think it's all that serious because look at Disney. It's just been stuck in this wide trading range for, let's just call it almost 4 years. And if I go further back, I mean, you could just see Disney has really gone nowhere since 2018, 2019. So using a microscope, this looks bad, but overall, Disney's just flopping around. So buy it at the lows of the range, sell it at the highs of the range until something fundamental changes. Otherwise, Disney to me is just essentially dead money. All right. C Limited sponsored ADR. This is basically an e-commerce, Asian e-commerce company based in Singapore, I believe. Some weird trading action last month. It plunged out of nowhere, no news, 9.6%. Then Bank of America magically and very opportune in an opportune fashion upgraded the stock to a $215 price target. I bet they're regretting that now because even though they got a good pop, sellers jumped right in. And that to me was the warning sign that something is not right. When sellers immediately fade a pop on an upgrade, something's not right. And sure enough, the market knew something because SE earlier this week lost 8.2% post earnings, confirmed a 200-day moving average breakdown. SE is further confirmed its bearishness. Now you can see this is happening in an overall uptrend. Sure, it stopped short of its all-time high, but there's still an overall uptrend going on since the lows of 2023. In other words, while this is bearish, buyers could at any time just decide, hey, this is a dip to buy because look at this great uptrend. I'm finally getting a discount on participating in the uptrend. So I don't have a trade on SE for myself. I did short it here and I bailed soon after that with a very small profit after Bank of America fooled me with its upgrade. I'm just going to leave it alone because, like I said, I think this stock is just going to have some really crazy moves in coming weeks. All right, let's take a look at a somewhat positive break. O'Reilly Automotive, ticker symbol ORLY. The stock did lose 2.9% post earnings last month, but check this out. Another picture perfect test of 200-day moving average. Man, I love these technicals. It rebounded. Now, this is a case where the rebound did not help in the most immediate term because you can see the sellers took over right after that. The next day, took it below the 200-day moving average, and this is when the buyers finally woke up to their opportunity. and now O'Reilly has been on this nice uptrend. Now it hasn't broken free yet of the bearish weighting, because look at this, the 50-day moving average is downtrending, 20-day moving average is downtrending, and the stock is losing momentum magically right below that looming overhead resistance. So I did buy this on the breakout on 200-day moving average. I'm a little wary, but I think it can hold just based on the technicals, not anything else. I think it can hold here even as it struggles to break over this resistance. Take-Two Interactive. Here's an example where the 200-day moving average also held after a post-earnings loss. Let me zoom in here for you. You can see it wasn't perfect, wasn't picture perfect, but it did work. The next day, sellers tried to punch through again and failed, and then the buyers took off from there. But the buyers quickly lost their nerve as soon as the price action got to the intraday high of the post-earnings day. I mean, the way technicals can work out sometimes is just pure magical poetry to me. And now buyers lost their nerve and sellers are stepping right back in, bouncing up and down, up and down, up and down. I think that bouncing up and down will continue to happen, but check this out again. I like to zoom back out on the longer term action just to show that overall Take-Two Interactive is on a bullish run. That means that this is probably a buying opportunity. Pick your spot and, have at it, do your proper risk management. Like, for instance, if I were to buy here, actually, I think I will buy around here next week, I would stop out at below the 200-day moving average and below this intraday low. Now, remember, I provide this content for educational purposes. Please use your own risk tolerance and time horizons to do your investing and trading. If you have comments or feedback, put them down below. Share and like this content so the algorithm knows what's up. And of course, you can subscribe and you can get further content like this one. All right, let's continue on. Shopify is one of those that really fooled me. I was trying to play a hold on this 50-day moving average support. It didn't hold. And on Thursday's big selling day, it plunged and confirmed a 50-day moving average breakdown. So this is just a totally busted trade. I did, I think, a calendar call spread. This move was so deep, it pretty much made that call spread worthless. It wasn't even worth my time. I didn't even bother closing out and taking the loss. Just, that was just an instant blow up. And what I was trying to do was, here's the warning sign, of course, right? The 6.9% post-earnings loss. The next warning sign is a 50-day moving average breakdown. What I was hoping is that this pop back up and hold was signaling a return to the bullishness that defined Shopify for quite some time. Look at how well this 50-day moving average held on previous tests. Now it's not holding, and now, like some other stocks that I pointed out, might be on its way to dribble on down to a test of 200-day moving average support. Lucid Group. Like I always say, when I grow up, I hope to have a Lucid car. May not happen at this rate. Let's see, what was this? Back in September, I expressed my displeasure at Lucid doing a inverse stock split. I forgot what the ratio was, a 10 to 1, 100 to 1. I can't quite remember. I wasn't happy because a reverse stock split almost always signals a weak stock and a weak company. It looked like the joke was on me soon after I said that because Lucid went into this rally, but this is one of these classic dead cat bounces, counter trend rallies. I mean, what I mean by counter trend is look at this overall trend for Lucid. I sold my shares. I had been trying to cling on to this thing, hope against hope, very bad trading acumen and discipline. I like the company and I just held the stock because I like the company. Very bad move. I admit it. Even I can mess up and get overly hung up on a particular stock position. But as I'm not surprised, after this rally ran its course, Lucid pretty much sold off almost every single day going into earnings. And then after earnings, they had another dead cat bounce. And then the sellers have just taken over again. Stock is at new all-time lows. All this to say is that at some point, the company will raise more money by selling shares. So that's kind of what happens when companies are doing these reverse stock splits, is they want to make it look better when they offer shares for financing. I'm not predicting. I mean, I have no idea whether they will do it. I hope they don't do it. I hope their finances get better. But this is what's probably coming, is more dilution, lower prices, single digits, and then another reverse stock split, and on and on and on it's going to go. I mean, I hate that Lucid has fallen into the cycle, but it is what it is. Maybe one day things will turn around, but it's just not happening for Lucid right now, unfortunately. All right, we're so sorry. This is such a doom and gloom, bad news post, but it is what it is. I just have to reveal, what's going on under the surface. I'm going to roll this out with some crypto talk. This is another one where I just have to tell it as the charts say it is. Too many companies announcing these crypto treasury operations. This is a recent one, Solana, that they changed their name. They were previously a medical device company, changed their name to Solana Company, ticker symbol HSDT. The market was very excited, as it always is on these announcements, soared 142%. And then you can see here, the buyers lost their momentum shortly after that, topped out, couldn't even make a higher close from over the intraday high, and sellers have taken over because this is just a moment to profit from. And what's even worse about some of these announcements is that the stock ends up not just reversing the gains from the initial pop, but it goes down to even further lows. So now HSDT, HSDT is trading at new all-time lows. And why am I warning about these is because so many of these companies are trying to revive a story that's been broken for years, sometimes decades in this case. Look at this stock. This is why I also followed this up after Lucid. This is a company that clearly has done many, many reverse splits or inverse splits, however you want to call it. Because at one point, this stock, believe it or not, was 26 million and $100,000 a share at one point. Now, of course, it never rolled out like that, but this is what has happened after it has reverse split so many times. So this stock, if it had never done these reverse split, would not just be a penny stock, it would be a fraction of a penny stock, if not for all the reverse splits. And as you can see, because of the way it's going, it's probably on its way to another reverse split at some point in the future. So I have been avoiding almost all of these, and I have one exception, which could end up burning me, but let's see what happens. Sequence is one. Sequence Communications is one I've written about. I'm only putting it up here as yet another example of this pattern. This company did a Bitcoin treasury operation. The stock soared. It actually looked like it was going to maintain some momentum on its biggest up day on the news and went up 88%. It was able to keep going up 2 more days. But after the buying momentum, after all the buyers were sucked in, you can see ever since then, very little buying interest, and sellers have just been taking profits. They're now ravaging the stock. People are clearly taking losses as the stock has not just reversed all of the gains from the announcement of treasury operations, it has continued down lower, lower, and lower to new all-time lows. And you know what I'm about to show you is that this is another stock that is trying to recover from many reverse splits. You can see that at one point, this stock traded at over $1,500 a share. And now it's back in the single digits. And at some point, it's probably going to do another reverse split one day soon at this rate. So these companies that are announcing treasury operations, there's only so many treasury operations that can even be useful for the market. And nobody knows how many we need, but clearly there are too many. Now, here's my one exception, and this is what might burn me, and I may end up regretting this, and I may look back and say, how ironic I didn't listen to my own advice on all the other treasury operation companies. But this one I'm trying to believe in only because Tom Lee, famous permabull, is involved. Now, I sat back and watched for a while because I wanted to pick my spots. So I started accumulating in this last pullback. But you can see here when when the company announced that Tom Lee was going to participate on the board, the stock soared. What was this? An amazing almost 700%. And actually, buyers continue to push into the stock. I think it's pretty clear that even the company was shocked and surprised by this because they turned around within days and offered $2 billion of sales, which didn't make sense because they're supposed to be investing money actually it did make sense because they wanted to put this money into buying Ethereum. But it did, of course, catch the market off guard. And you could see here that the sellers went right to work. And this stock went down and down and down. And suddenly you could see the company said, uh-oh, maybe we put out too many shares for sale. And then they stepped in and did a $1 billion repurchase. I mean, these stories can almost not get weirder. So right after announcing a treasury operations, they offered 2 billion of shares to the market. I don't know how many of those shares they actually ended up selling. And then they turn right around again and say, "Oh, we're going to use 1 billion to repurchase shares." Yet this is a treasury. This company has switched to this company is BitMine Immersion Technologies, ticker symbol BMNR, but they're supposed to be using money to buy Ethereum. And now they're going to take a big chunk of change and buy shares. It's really kind of bizarre. Now, this news did work, and the stock bounced. You could see technicals at work, bounced sharply off 50-day moving average. That was wonderful and great. And actually, this support, this place where they did the repurchase authorization, has held as the low. This is what I'm counting on as the stock drifts lower again, that the company is going to exercise this money to buy shares and defend the stock, because it's going to need defending very soon as it drifts towards, guess what? 200-day moving average support. If they don't successfully defend this stock at this support level, watch out below. And BitMine Immersion Technologies could end up being up just like all the other treasury companies, drifting down, reversing all of the earlier euphoria, reversing all the way down to new lows. Don't want that for the company, but this is the danger. This is the downside risk. And you know what I'm going to do? I want to look at the long term just to give some perspective on where this company has been and check that out. Sure enough, this one takes almost the record, right? This stock was trading one time at $477 million per share again. And this was way back in the dot-com bubble starting in 1998 through 2000. I can't even remember what this company used to do or be. Clearly, the business they rolled out and the IPO coming to public market was quickly a disaster. Went from, let's just call it actually $500 million all the way down to 64,000. So it lost almost 90% of its value within 4 years, right? Let's just say around 4 years. And it's been a downhill sled ever since, almost ever since. The company has been able to kind of stabilize since 2019, but still, they have not been able to find a successful formula. Hopefully, they have finally found it with this treasury operation and with Tom Lee's help. He's a great hype man. He's on TV and he's on YouTube a lot, talking his perma-bull game. So maybe that will help this particular treasury company make it, unlike all the others that are rolling out and doing copycat strategies. Now, what's risky, of course, for all of these treasury companies is that it relies on the crypto staying aloft and being strong. And that's exactly what has not happened since this peak in October. Very telling, Bitcoin since August has had two big breakouts that were fake outs to all-time highs. The last one finally broke the back of traders. And Bitcoin has been selling off ever since. As I often do with my own crypto trading strategy, I'm buying the dips, I'm accumulating on sell-offs. What's been missing is outright panic. I really like to buy into crashes. Crashes are the best buying opportunities. But this has just been this slow, torturous sell-off. And so I've had to buy in smaller amounts and more frequently than I really want to. And I just bought one more time at 95,000. But I'm afraid that with this break below 100,000 and staying below 100,000 this long, that Bitcoin is now truly in bearish territory. You can see the breakdowns: 20-day moving average, 50-day moving average, 200-day moving average. It's at a 6-month low. You can't get more bearish than this. Now these breakouts, these fake outs, all-time highs look like a double top. So I expect Bitcoin to really churn and maybe sell off even lower for quite some time before this turns around. This is very bad news for all of these treasury companies that have been rolling out in recent months, right? So that's, again, a risk also for BitMine Immersion Technologies, is that if crypto continues weaker, there's only so much defense that they're going to be able to do with their buyback authorization. All right, Been a lot of doom and gloom, a lot of bad news in this video. Let me end off on at least one good note, which is a biotech company that I've talked about. Actually, so I don't know whether I've talked about this one on video or in my blog. So apologize if I haven't. But this is another case where I noticed the CEO. This was a great one because the CEO bought up shares twice. And I forgot to label it, but here's earnings. Um, Sellers tried to shake people out of the stock here. It held 50-day moving average support like a champ, rebounded, and then drifted higher into what was yesterday a PDUFA, a successful PDUFA announcement. This is when the FDA has approved its drug for all sorts of indications. I won't go into all the details. You can, of course, read about it on the internet. Now, I don't like this big fade from 1250 back down to 1121. So it could be that the current excitement is running its course. If so, I'll be forced to just go ahead and take profits at some point. That's why I wanted to mention this. I was hoping this would be just 100% good news. The good news here is that, following the signal of insider buying worked like a champ here. It doesn't always work. It doesn't have to work, but in this case it did. And then the stock so far is surviving the sell the news. So that is the other slight positive here, which is usually after great news like a successful PDUFA announcement, sellers will just step in and people just take their profits and think that this is as good as it can get. In Kura Oncology's case, I don't think this is as good as it gets, but I will have to obey and defer to the technicals if new weakness takes the stock down much lower than where it is now. It doesn't make sense for me to risk all the hard-earned profit just because the technical sellers want to make havoc before the stock can then go on its next leg higher. All right. Thanks for hanging in there. Again, as a reminder, you can hit that subscribe button, get more content like this. You can also go to my blog, drduru.com/122 if you want more details. Thank you for hanging in there with me, and I will see you the next time. Take it easy and safe trading and investing out there.